If you're in your 50s and feel like taxes are eating away at everything you have worked so hard to build, you're not alone. It sucks. This is actually one of the most critical decades of your financial life, and the decisions you make right now about how you earn, save, spend, and invest will determine how much of your money actually stays in your pocket when you retire. Today, I'm going to walk you through specific actionable steps to legally reduce your income tax burden in your 50s, and I'm covering two different situations. First, people who are still working through tight budgets and need every dollar to count. This is me. Second, people who have paid off debt and have extra money to work with. This is not me, but I'm almost there. Stick around though, because by the end of this module, you will have a clear roadmap for both situations. Let's start with why your 50s are actually the best time to get serious about this. The IRS actually gives people over 50 additional benefits that younger workers do not get. These are catch-up contributions, and they are specifically designed for this stage of life. So if you have not been maximizing your retirement accounts in your 30s and 40s, don't panic. Your 50s are your power decade to catch up and reduce your taxes at the same time. Go get that star, Mario. Before we get into the specific strategies, I need you to understand one fundamental principle. Every dollar you legally move into a tax-advantaged account is a dollar the IRS cannot touch this year. That is the core of every single strategy we are about to discuss. You are not cheating the system. You are using the system exactly the way lawmakers designed it to work. Let's start with the basics for people in their 50s who are on a tighter budget. Maybe you're paying off a car loan, still have a mortgage, or just trying to keep up with regular expenses. These first steps cost you nothing to implement and can reduce what you owe immediately. Step 1 is to take advantage of your employer's retirement plan right now. If your job offers a 401k or a 403b, and you are not contributing at least enough to get the full employer match, you are leaving free money on the table and paying more taxes than you need to. Every dollar you put into a traditional 401k or 403b reduces your taxable income for this year dollar for dollar. In 2025 and beyond, folks over 50 can contribute significantly more than younger workers, thanks to those catch-up provisions we mentioned. This is arguably the single most powerful tool available to you at this stage, and it doesn't require you to have extra money. You're simply redirecting money you were already going to earn into an account that protects it from taxes. Step 2 is to look into a health savings account if you have a high-deductible health plan through your employer. An HSA is one of the only triple tax-advantaged accounts that exists in the entire United States tax code. The money you contribute reduces your taxable income today. It grows tax-free inside the account. And when you spend it on qualified medical expenses, you pay zero taxes on withdrawal. In your 50s, your healthcare costs are likely increasing, so using an HSA to pay for those expenses with pre-tax dollars is a smart move for almost everyone who qualifies. Step 3 is to check whether you qualify for a traditional IRA deduction. If you're not covered by a workplace retirement plan, or if your income falls under certain thresholds, you may be able to deduct traditional IRA contributions from your taxable income. Again, people over 50 get extra catch-up contribution limits here as well. This is a retirement account you open entirely on your own, outside of work, so it's available even if your employer does not offer great benefits. Step 4 involves something most people completely overlook, which is their commuter benefits. If your employer offers a pre-tax commuter benefit program, use it. You can set aside money before taxes to pay for transit passes, parking, or ride-sharing. It is a small benefit, but it reduces your taxable income with zero additional cost to you and takes about 5 minutes to set up. Step 5 is to double-check your W-4 withholding settings with your employer. Many people in their 50s are accidentally over-withholding or under-withholding, and under-withholding can actually result in an IRS penalty on top of your tax bill. Visit your payroll department or your online payroll portal and review what you have set up. Correcting this ensures you are not giving the government an interest-free loan all year, and it prevents surprise penalties. Now let's shift into the strategies for people in their 50s who have more financial flexibility. Maybe you've paid off your home, eliminated credit card debt, or received an inheritance or promotion. You have extra cash flow and you're wondering how to deploy it as tax efficiently as possible. These strategies are where things get really interesting. Strategy 1 is to maximize every single retirement account available to you simultaneously. Now that you have extra cash flow, the goal is to fill up your 401k or 403b to the absolute maximum allowed limit, including catch-up contributions. After that, fund a traditional IRA or a Roth IRA, depending on your income level. These accounts aren't just retirement savings vehicles, they are tax reduction tools. Every dollar you put into a pre-tax account shrinks the income the government can tax you on right now. Strategy 2 is to consider a Roth conversion strategy. This one requires some careful planning, but it is extremely powerful in your 50s, especially if you expect to be in a higher tax bracket in retirement, or if you want to reduce future required minimum distributions. A Roth conversion means you take money from a traditional IRA or 401k, pay the taxes on it now, and move it into a Roth account where it will never be taxed again. The best time to do a Roth conversion is during a year when your income is temporarily lower than usual. Working with a CPA to identify your optimal conversion amount each year can save you enormous amounts in taxes over the long run. Strategy 3 involves your investment accounts outside of retirement. If you hold stocks, funds, or other investments in a regular brokerage account, pay attention to how long you hold them before selling. Investments held for more than 1 year qualify for long-term capital gains tax rates, which are significantly lower than ordinary income tax rates. In some income ranges, the long-term capital gains rate is actually 0% at the federal level. So simply being patient with your investments can result in dramatically lower taxes when you sell. Strategy 4 is tax loss harvesting. If any of your investments have declined in value, selling them to realize those losses can offset gains you have made elsewhere in your portfolio. Investment losses are tax deductions. They reduce your taxable income. You can then reinvest the proceeds into a similar but not identical investment to maintain your portfolio positioning. This strategy is especially useful during years when markets are volatile. Strategy 5 is to explore a 529 education savings plan if you have children, grandchildren, or even yourself considering further education. While you will not get a federal tax deduction for contributions, many states offer a state income tax deduction, and the money grows completely tax-free as long as it is used for qualified educational expenses. In your 50s with grandchildren perhaps on the horizon, this can be a meaningful tax planning tool. Strategy 6 is the one most people in this category miss entirely, and it relates to rental income. If you own a second property or are considering renting out a room or your home temporarily, be aware of the minimal rental use rule. If you rent your home for 14 days or fewer in a calendar year, that income is completely tax-free. You do not report it. You do not pay federal taxes on it. This is a legitimate provision in the tax code that is widely underutilized. This isn't financial advice, you know the drill. Now let's talk about what happens as you approach the end of your 50s and start looking toward retirement withdrawals. This is where strategy becomes incredibly important because the order in which you draw from your accounts determines how much tax you pay. Hopefully, you'll have dividend income by this point, so you won't have to withdraw anything at first, but just in case you do, the general principle is this. In retirement, you want to draw from taxable brokerage accounts first, then traditional retirement accounts, and preserve your Roth accounts for as long as possible, because Roth money grows and comes out tax-free indefinitely. However, there's an important exception to consider. If you are approaching 73, you will eventually face required minimum distributions from traditional retirement accounts. These forced withdrawals can push you into a higher tax bracket unexpectedly. The way to mitigate this in your 50s is to start gradually drawing down or converting your traditional accounts now, before those required distributions kick in, and before Social Security adds more taxable income to your picture. Speaking of Social Security, timing matters. Depending on your other sources of income, some portion of your Social Security benefit may become taxable. Working with a financial planner or CPA to model out different withdrawal scenarios before you claim can save you thousands of dollars over the course of retirement. Let me give you a quick summary of the action steps because I want this to be as practical as possible. If you are on a tighter budget right now, start by contributing enough to your workplace retirement plan to get the full employer match. Open or fund an HSA if you qualify. Verify your IRA deductibility and open one if you do not have one. Set up commuter benefits through your employer if possible. Review and correct your W-4 withholding. These 5 steps can reduce your tax bill immediately. If you have extra income and financial flexibility, maximize all retirement account contributions, including catch-up amounts. Work with a CPA to evaluate Roth conversion opportunities year by year. Hold investments for over a year to access long-term capital gains rates. Harvest investment losses strategically to offset gains. Explore state-level 529 deductions and begin modeling your retirement withdrawal sequence now to minimize future required minimum distributions. One final thought before you go. None of these strategies require a high income or a financial genius. They only require attention, intentionality, and ideally a good CPA or financial advisor who can help you see around corners you did not know existed. The tax code was written with these provisions in your favor. Your job is simply to use them. Your 50s are not too late. In many ways, they are exactly the right time. So take one of these steps this week, just one, and build from there. I hope you got a ton of value out of this video, and if you did, please watch my comprehensive guide to financial freedom starting from nothing video, which you can click on right here. Also, please consider liking and subscribing, and drop your own thoughts and ideas in the comments. My name is Flint, and I will see you in the next video.